Welcome to the debate. Consider the security cameras installed in a massive retail supermarket. I mean, for decades, they were put there for one entirely defensive reason, which is loss prevention.
Right, you record the aisles, you stash the tapes in a back room, and nobody ever actually looks at the footage unless there's, a shoplifting incident. It is pure organizational overhead.
Exactly. It's just a cost center. But then one day, someone realizes that this exact same footage is continuously capturing the precise physical foot traffic of every single customer.
Yeah.
It shows exactly where they pause, what end caps they completely ignore, how they navigate the store from entry to checkout.
Because the data was already there, right? Accumulating perfectly. It just required a paradigm shift to stop looking at it as a theft prevention system and start seeing it as a behavioral map.
Right.
And once you realize that, you can use the footage to completely redesign your floor plan, optimize your product placement, and potentially double your sales.
And just like that, it transitions from a defensive cost center to an offensive intelligence-generating asset. So today we are looking at a phenomenon in the corporate world that mirrors this perfectly. We are diving into the emergence of continuous transaction control, or CTC environments, and how global enterprises manage value-added tax, or VAT.
Which is quite the leap from supermarket cameras, but I see where you're going.
Hey, the analogy holds up. Historically, indirect tax has been viewed as the ultimate compliance-focused organizational overhead. I mean, it is technically complex, it's completely invisible to the consumer when it works, and it's widely perceived by executives as just a necessary cost with zero strategic consequence. The global shift to real-time transaction controls fundamentally transformed the VA compliance layer into the enterprise's most valuable, real-time strategic intelligence asset.
Or, conversely, does the architectural and organizational friction of translating that regulatory data into business strategy severely limit its practical utility beyond, well, basic tax obligations?
Exactly. And I look at this bidirectional architecture and I wonder, could this actually be the offensive powerhouse that companies are missing? I mean, I argue that it yields unparalleled real-time visibility into cash flow, supply chain risk, and margin intelligence.
And I come at it from a different way. While the sheer scale of the data is undeniable, we really have to remain grounded in reality here. This data is fundamentally a regulatory construct.
Sure, but it's data.
It is, but extracting strategic enterprise value from it requires massive organizational and architectural leaps. Leaps that, frankly, severely underestimate the inherent structural silos between tax, treasury, and procurement.
Well, let's establish the baseline of what we are actually looking at when we talk about VAT data. Because I think a lot of people still picture, old school tax returns.
Stacks of paper on an accountant's desk?
Exactly. Let's break down exactly what happens in a continuous transaction control environment. Because CTC sounds like heavy corporate jargon. What are the actual mechanics here?
Sure. So in the old days, and by old days I mean literally a few years ago for most countries, a company would make, say, 10,000 sales in a month. At the end of the month, the accounting team tallies those up, calculates the VAT owed, and sends one aggregated summary report to the government.
A retrospective snapshot, essentially.
Exactly. But under a CTC framework, the government inserts itself directly into the live transaction. When you generate an invoice for a customer, before that invoice is even legally valid, it must be sent electronically to the government server.
Right.
The tax authority validates it in real time, applies a cryptographic token or a clearance number, and then sends it back. Only then can you actually send the invoice to your customer.
And this is happening in milliseconds.
Milliseconds. Yeah. But think about the data being captured. The government is essentially building a real-time mirror of the entire country's economy, line item by line item.
Which makes it an incredibly comprehensive data set. I mean, if you look at standard customer relationship data in a CRM, you get deep insights into sales, right? But it tells you absolutely nothing about your supply chain.
Correct.
And if you look at procurement data, you understand your supply, but you have a blind spot regarding your sales. VAT compliance data comprehensively covers both, every purchase and every sale, standardized across entities and geographies. It's all there.
I don't disagree on the volume of the data or even the theoretical completeness of the dataset. It is massive. but we have to look closely at the operational reality highlighted in the source material. This data is, quote, routinely filed and forgotten.
But that's just a habit.
Is it? The text explicitly must that nobody in Treasury even knows it exists, and there is a very structural reason for that. VAT data is inherently structured for tax authorities, not business leaders. It is formatted to satisfy a sovereign government's specific audit requirements.
That's an interesting point, though I would frame it differently. The reason the data is filed and forgotten isn't because the tax department lacks the intellectual capacity to understand its value.
I'm not saying they lack capacity.
No, I know, but it's because of the historical limitations of the technology, specifically how the data flows. Historically, tax reporting was a one-way street. The company's ERP system sends a tax report to the government. That's an outbound flow. But now, we're talking about a bi-directional data flow.
Meaning the data comes back into the company?
Exactly. When you send that invoice data to the government sends back that real-time approval receipt. Instead of just filing that receipt in a digital drawer to prove you complied, a bi-directional flow pipes that live approval directly back into the company's internal business systems.
Turning a compliance ledger into business intelligence still requires deliberate architectural investment. More crucially, it requires the analytical capability within the tax function to translate compliance data into insights that are actionable by non-tax audiences.
Which they can develop.
Expecting a defensive, penalty avoidance tax department to suddenly act as an intelligence hub is a highly unlikely operational reality for most enterprises.
But look at the sheer granularity of the record we are getting back. At a minimum, every single transaction captures the identity and tax registration status of both parties.
Sure.
It captures the full line item detail of the goods or services, the classification, quantity, unit price, tax base, and margins. It even captures the exact timing and currency of the transaction. Think of traditional tax filing like looking at a physical paper map of where you drove last month.
Right. It tells you where you were, but it's totally useless for making a decision right now.
Exactly. What CTC does, this real-time bidirectional flow, is turn that paper map into a financial GPS. It's like Waze for your enterprise capital. It tells you there's a traffic jam right now, allowing Treasury to reroute their cash flow instantly.
That's a great metaphor, but
Building an analytical outbound flow gives you that live GPS screen. It provides pricing analysis by product category, customer segment, and geography based on actual real-time transaction data rather than just, system of record approximations.
I'm sorry, but I just don't buy that. Let me tell you why your financial GPS analogy falls apart in a real corporate environment. You're assuming the car's computer will just let you plug that GPS screen into the dashboard without a fight.
Why wouldn't it? It's just an API connection.
Because of the IT department, the architecture we're talking about here requires 3 distinct flows. Currently, most enterprise architectures implement only 2, the inbound data flow from the ERPs into the tax engine and the outbound regulatory flow to the tax authorities.
That's it.
Right, the basics.
You're talking about building a third flow, an analytical outbound flow to financial reporting, treasury, and supply chain applications. Building that bridge requires overcoming massive structural silos. IT departments are historically terrified of letting anyone touch the compliance layer. Well, because of the risk profile.
Exactly. If the marketing department's analytics software goes down, the company loses ad optimization for a day. If you break the regulatory outbound flow while tinkering to build a treasury dashboard, what happens?
You fail clearance.
You literally cannot clear invoices. In some countries, if that clearance fails, the physical truck is legally prohibited from leaving the loading dock. The company halts operations or faces massive fines.
That is a fair concern.
The compliance architecture satisfies the regulatory obligation, and yes, it leaves the data on the floor, but it does so because the risk of tampering with the tax engine to build a GPS for Treasury is viewed as unacceptably high by any chief information officer.
I'll admit, when I first read about this, I was confused. If the data is so incredibly valuable, why hasn't it been monetized yet? But looking at the IT constraints you just mentioned, it makes total sense.
It's risk management 101.
However, if IT is so terrified of letting internal teams touch the tax engine, we don't necessarily have to touch it. We can just look at the external signals the system is already generating.
What kind of external signals?
Let's pivot to supply chain risk. specifically looking at procurement. In jurisdictions with CTC frameworks, the validation of a supplier's VAT registration status is a mandatory element of every single transaction.
Right, the clearance process.
The platform checks the counterparty registration in real time. If a supplier fails that VAT registration validation, it is not merely a compliance glitch. That is an external, immediate, early warning signal about a counterparty's business health.
So you're saying a tax rejection is a procurement red flag?
Precisely. Relying on this intelligence allows procurement to act exponentially faster than they would by relying on traditional, periodic credit checks. It maps geographic exposure, and it captures delivery performance signals embedded right there in the transaction timing.
That is a fascinating theoretical application. But I have to push back on the actual scope and reliability of this intelligence. A VAT registration failure is, at its core, a tax compliance issue.
But it reflects wider issues?
Does it? Relying on an indirect tax layer to map supply chain volatility is a massive oversimplification of enterprise risk management. If you're listening to this and thinking, my tax department can barely file on time, how are they going to act as a supply chain watchdog? That's exactly the friction we're talking about.
But the signal is real data. It's objective fact.
Is it actionable data, though? Why did the supplier fail the check? Maybe they are facing insolvency, or maybe they just had a bureaucratic mismatch in a local provincial tax office. Maybe their accountant just filed a form late.
That seems like an excuse for ignoring bad signs.
Procurement systems, supplier relationship management software, these tools exist specifically to track holistic supply chain health, delivery performance, and credit risk. If you force the tax department to act as a supply chain watchdog, you are conflating a narrow regulatory hurdle with holistic business health. You risk generating a flood of false positives that procurement will quickly learn to just ignore.
I'm not convinced by that line of reasoning because a failure to comply with sovereign tax authorities is rarely just an isolated bureaucratic hiccup in a modern enterprise. It is highly correlated with liquidity issues or operational distress.
Sometimes, sure.
If a company stops paying its VAT, it's usually because they can't make payroll. But even if we assume procurement might be skeptical of tax data, let's shift to where the financial stakes are absolute and the translation is direct. Let's talk about the treasury function and cash flow visibility.
The holy grail of working capital.
Exactly. VAT represents a massive working capital asset or liability for every global enterprise. Input VAT paid on purchases generates refund claims. Output VAT collected on sales creates payment obligations. Treasury teams are desperately trying to optimize cash flow, relying on forecast models.
Which are often just educated guesses.
Right. But by routing VAT data correctly, Treasury can see total refund claims outstanding net of payment obligations in the next 30, 60, or 90 days. They can identify precisely which refund claims are blocked and exactly why they are blocked.
In theory, yes, if they have the data.
Let's ground this in a real scenario. Imagine a multinational company with $500 million in tied-up cash. Why is it tied up? Let's say your accounting period closes on the 30th. You owe a supplier $50 million, which includes $10 million in VAT that you can claim back.
Okay, following.
If accounts payable runs the payment on Tuesday the 30th, you claim that $10 million back on the current month's filing. But if they wait until Wednesday the 1st,
You have to wait an entire additional filing cycle to get that cash back.
exactly, that $10 million is trapped. It is cash drag generated purely by a disconnect between payment runs and the local VAT calendar. If Treasury had this real-time intelligence, they could optimize the net VAT position and liberate material cash. It is a Treasury intelligence asset generated as a byproduct of compliance processes already running.
That's a compelling argument, but have you considered the organizational psychology at play here? We have to ask the obvious question. The text claims that this is merely a modest investment. It suggests that the gap between Treasury's need for visibility and the tax layer's data is simply an architecture problem requiring a standard export-import bridge.
Yes, a technical hurdle.
If it is that simple, if it is just a modest IT bridge, why hasn't it been done globally already?
Because of the IT silos we mentioned earlier.
It's deeper than just IT silos. The bottleneck is profoundly structural and behavioral. Tax and Treasury speak entirely different languages because they are incentivized by completely opposite mandates. The tax function justifies itself defensively. Their metric for success is risk avoidance. Did we get fined? Did we pass the audit? Their success is essentially the absence of disaster.
Right, a very defensive posture. I agree.
Meanwhile, Treasury's mandate is liquidity and yield. Make our money make money. They are an offensive function. When you ask the tax department to start building predictive models for Treasury, you are asking a team trained to be deeply cautious and historically accurate to suddenly become forward-looking and speculative. That is a massive cultural clash.
It is a shift, certainly.
The material suggests that a global head of tax can just walk into a CFO meeting with a VAT cash flow intelligence brief and magically dissolve entrenched organizational behavior. Changing a cost center into an intelligence function requires a cultural overhaul that a simple data bridge cannot engineer on its own.
I see why you think that, but let me give you a different perspective on why that cultural overhaul is happening right now, whether those entrenched silos like it or not.
Okay, I'm listening.
The catalyst isn't just a proactive head of tax. It's external regulatory pressure forcing the issue. Look at the OECD's Pillar 2 Global Minimum Tax Framework.
Oh, a massive compliance headache for multinationals.
Exactly. For those who aren't living and breathing tax code, Pillar 2 essentially requires multinationals to prove they are paying a minimum effective tax rate of 15% everywhere they operate.
Right.
To calculate that, you need granular, consistent, cross-jurisdictional data on profits and taxes. Historically, direct tax data like corporate income lives in one silo, and indirect tax data like VAT lives in another. You now have to reconcile them.
Which is incredibly difficult.
It is. But this new requirement overlaps substantially with the transaction-level data already captured in a well-structured indirect tax compliance layer. Organizations are now being forced by international law to build integrated direct and indirect tax data architectures just to comply with Pillar 2.
Because the data has to be centralized anyway to satisfy the OECD.
Exactly. Because they have to build these bridges anyway, the leap to utilizing that architecture for full strategic intelligence, for cash flow visibility and margin analysis, it becomes both timely and economically necessary. The data assembly is dramatically simpler for organizations that are finally forced to stop siloing their tax data.
I will concede that Pillar 2 is a massive forcing function for data integration. It is an undeniable architectural catalyst, but we must distinguish between assembling data for a global minimum tax calculation and operationalizing that data for daily treasury and supply chain decisions.
Why? The data is there.
Just because the data is centralized for the OECD does not mean the supply chain manager in Singapore or the treasury analyst in London has the dashboard, the access, or the context to use it.
But the bridge is built.
The IT bridge is built, sure, but what about the human bridge? The source material rightly points out that this requires analytical capability within the tax function to translate compliance data into actionable insights for non-tax audiences. You are asking tax professionals who are trained in the highly specific nuances of cross-jurisdictional regulatory code to suddenly become business intelligence analysts and supply chain risk forecasters. That is a massive skills gap.
It is a skills gap, but it's one that the market is rapidly closing because the financial incentives are simply too large to ignore. And frankly, you aren't asking the tax professional to be a supply chain forecaster.
You kind of are, though.
No, you are giving the treasury analyst a VAT lens to do their existing job better. When you identify which markets are generating structural VAT cash drag, whether through slow refund processing or complex claim procedures, the CFO gets data directly relevant to working capital strategy.
But notice the prerequisite in your own scenario. You need the treasury analyst to care about the VAT calendar, and you need the tax professional to understand Treasury's payment run schedule. The material states, quote, "The tax function that can run these scenarios in advance provides the CFO with more reliable decision support than any Treasury model."
Right.
I agree the transaction record is a factual, real-time reflection of commercial activity. But treating the tax department as an internal consulting firm for the CFO underestimates the daily operational burden of just staying compliant in a CTC environment.
You mean the day-to-day firefighting?
Exactly. Continuous transaction controls mean the tax authority is in your ERP system in real time. We talked about how an invoice failing clearance means a truck can't leave the dock. The tax department is firefighting those real-time clearance failures constantly. Asking them to simultaneously run working capital scenario models for the CFO is a wonderful vision, but operationally it stretches a defensively oriented team to the breaking point.
Which brings us precisely back to why the architectural investment is necessary. You automate the outbound regulatory flow so that the tax team isn't manually firefighting clearance failures, freeing them to manage the analytical outbound flow.
If automation were that perfect, nobody would need a tax department.
But the professionals who make this transition are changing what their jobs are worth to the organization. A tax function that only prevents penalties commands one level of resource allocation. A tax function that optimizes working capital and surfaces real-time margin intelligence commands an entirely different level of executive visibility.
Visibility, yes, but also culpability. When the tax department steps out of its compliance silo and starts informing pricing strategy and cash flow optimization, they own the outcomes of those business decisions. I think many tax leaders are comfortable in the defensive posture because the metrics for success are binary. Did we get fined or did we not?
That's fair. I think we are arriving at a clear distillation of the two realities facing modern enterprise tax functions.
I'd say so.
The transition to real-time VAT intelligence is not merely theoretical. It is already happening. The compliance layer is capturing a real-time financial model of the organization's commercial activity.
The data is certainly there.
Right. And with the right bidirectional architecture, one that pipes the government's real-time receipts back into internal systems, the tax function can completely shed its historical defensive posture. It becomes a vital, offensive intelligence contributor that provides Treasury with 30, 60, and 90-day net cash positions, provides procurement with early warning risk signals, and provides leadership with transaction-level pricing strategy.
And to summarize my perspective, while I completely agree that the CTC dataset is unparalleled in its scope and its regulatory grade validation, we cannot ignore the friction of reality. Elevating the tax function from a defensive compliance cost center to an offensive enterprise intelligence hub severely underestimates the difficulty of cross-functional data translation.
The human element.
Exactly. The silos between tax, treasury, and procurement exist for deep behavioral reasons rooted in opposing psychologies, risk avoidance versus yield. Overcoming them requires not just a modest data bridge, but a fundamental rewiring of organizational behavior and skill sets that most companies are simply not prepared to execute.
Well, both perspectives highlight the profound shift occurring in global finance. Regardless of how difficult the internal implementation might be, real-time transaction data is accumulating globally. The landscape of indirect tax is fundamentally shifting from periodic reporting to continuous control, and that data is just sitting there.
It is accumulating, inevitably. And it forces a conversation every CFO will eventually have to navigate.
Absolutely. We suggest our listeners explore the source material further, particularly the sections detailing how planned business changes, like major acquisitions, supply chain restructurings, or new product launches, can be modeled directly from this compliance data layer rather than relying on abstract forecast assumptions.
It's a fascinating read, especially if you look closely at the actual mechanics of building those analytical data flows.
We started today by talking about a supermarket's security cameras, how a system built entirely to play defense, to catch errors and prevent loss, was secretly capturing the exact data needed to optimize the entire business. Your VAT compliance layer has been recording the foot traffic of your global enterprise's capital for years. The only question now is, when are you going to stop using it just to catch mistakes and start using it to design your future? Thank you for listening.